Even though I worked on Wall Street, I'm actually a trained mathematician. And I really like equations. They simplify complexity, they bring clarity. But in finance, there really is one equation that reigns supreme, and that is what we call the risk-return equation. But what if this equation isn't just a mathematical model? What if it actually could be something sacred? A balance that needs to be respected, needs to be deeply respected, much like the balance that many speakers here have spoken about, but also that we just find in nature. I'd just like to pose a question before I begin. How many people in this room consider themselves investors? Okay, great. Well, I think everybody's an investor because we have more than money, time, talent, voice, vote, resource, whatever it may be. You're all investors in this room. So I'd like for you to put that hat on. And I'd like to just pose a fundamental question. How do you think about risk? So to start off, you'll actually see, contrasting economies here. When you think about countries with high growth potential, where does your mind go? We can almost do the exercise that Joy did with us yesterday. Close your eyes if you want to and think about a high growth economy. I can assure you that you're not thinking about Kenya or India, the two countries, or the two places that represent portions of my portfolio. You're probably thinking about Germany or Japan or what we would call a developed economy. But I would like to share with you that Kenya and India, which we call emerging markets, are not as risky as we actually think that they are. In fact, they're outpacing developing countries when it comes to growth, and this is something that really shouldn't be ignored. So let's look at the data. When we look at Kenya versus Japan, we have tremendous growth in Kenya. The world will be African in 2050. That's a really important thing to know. 1 in every 4 people on the planet will live on the African continent, 70% of the world's youth, and the numbers are here to support that. It's not only growth rate of GDP, but it's growth rate of population, as well as significant mobile money adoption. And when we compare this all to Japan, we have slow growth, we have declining population, and we also have a dominant traditional banking system. So not so much innovation or capability or possibility for innovation. When we think about India, 1.43 billion people, largest population on the planet, there is a balance between growth and stability when we compare it to a developed economy like Germany. So again, very high GDP growth, population growth is strong, and mobile payment adoption, which again just serves as the rails for innovation, particularly around fintech, an area where I invest in my venture fund, is really developing. India has over 100 unicorns and has a rapid expansion in technology, and the currency is relatively stable. And when we look at Germany, I think you all know, we've read the FT or the Economist to learn about how Europe's growth is just slowing. And why this all matters is because there's a perception and reality distortion when it comes to risk. And I want to unpack from my perspective why emerging markets are considered riskier, to then come back and discuss risk in general and why it is really important that we view risk and return as a sacred equation. So when investors are looking at Kenya and India and seeing high risk, they're typically seeing more political instability, and they're ignoring higher growth potential, and which comes with volatility. So they're seeing volatility in the markets. They're seeing fear. When they look at developed markets, the perception is less political instability and higher growth potential. But let's look at reality for a moment. Taking emerging markets, we have higher growth potential and less instability driven by the demographic tailwinds. as well as what we call economic liberalization. And what economic liberalization is the ability for policy to unleash private enterprise and capital markets to generate supply and demand, to generate business and to generate economic development. Now, when we think about developed markets, the reality is actually there's lower growth potential and more instability caused by the demographic headwinds, as well as we are in 2024. I have to say it, political dysfunction. So, in investment, I think it's really important to always respect the equation of risk-return as inseparable from impact. You see here, impact is the fulcrum of this trade-off. So it isn't just, I get a higher return, I accept higher risk, I get a lower return, I accept lower risk. Absolutely not. There's another piece of this equation, and it is impact. So I have the benefit of having a father who grew up in Africa. I worked on Wall Street, and I just decided to cross to the other side of the table and start investing in emerging markets over a dozen years ago. And through the funds I've invested in, particularly across Africa and in India, I took a bet. They were really considered extremely risky over a decade ago. And I remember the meetings, as I've cultivated investor relationships. And often I try to explain this incredible opportunity to investors, and their eyes just glaze over. But there are some investors who have really understood what the potential is, who have looked at risk from a different lens. And so I'd like for all of the people in this room, especially those who consider themselves investors, but again, I think we all really are investors, to think about, is the traditional view of risk too narrow? So why this equation really matters is that aside from the trade-off of higher risk, higher return, lower risk, lower return, the consequences of focusing on this narrow interpretation can be devastating for society. You see here society, environment, future generations can be impacted by all of our investment decisions. Let me give you a few examples. Number one, WeWork. This is a case of severe founder and business model risk. I don't care if venture funds are still backing the founder. The business model created deleterious impact in society and also set us up to view leadership in a very dangerous way. The second is FTX. Major operational risk, a flat-out fraud, leading to massive losses and a market downturn where everyone suffered. And then finally, I had the, I would say, benefit of working on Wall Street during the financial crisis. And the trade that really got me and actually made me move to emerging markets and be more heart-centered about the way that I invest is the Big Short trade. That was significant economic risk, where one single bet against homeowners destabilized the entire banking system. As we all know, Lehman Brothers went bankrupt, and the crisis that ensued affected millions, and it did impact future generations. We're living that right now. So these failures not only impacted the investors, the risks were way bigger than just loss of return. They were much larger, and they had an impact on what I would call all stakeholders. Not only the people in society, the planet, the youth, and our view of what leadership actually looks like and what investment should look like. So, it's a bit of a brutal truth, but there is no such thing as a neutral investment. Investments have never been about only financial return. There are always wider impacts to consider. Let's take the easy, low-hanging fruit example of oil. It's great. get from point A to point B. Our whole economy is based on fossil fuels. But the reality is the long-term impact is deleterious and massive. I want to tell you about an incredible investment that serves as a really good example for thinking differently about risk. In 2017, I made a seed investment in a company called Kasha. Kasha is a company based out of Rwanda and Kenya selling women's health products. They sell them direct to consumer. They sell them to small shops that also then sell them to the consumers and women who need them. At the time I invested in this company, it had $20,000 of revenue. It's pretty low. That's a pretty bold bet. But as a woman in America, I knew that if there was no access or no one-stop shop for my healthcare needs, the opportunity would be massive in underserved markets like Africa. So this wasn't just about financial profit. This was about access to a need to have, access to healthcare. It was about creating an equitable access. And here's how it played out. So fast forward 2024, Kasha is the top e-commerce platform on the African continent, operating in 5 countries. It reaches women with not only healthcare products, but everything they need, because we all know that women make the spending decisions in the household around the world. By 2023, they were reaching over 1 million female customers annually, generating $45 million in revenue. $45 million in revenue. That's incredible. And selling 8.6 million healthcare products by the second quarter of this year. So with this company, women now have better access to healthcare, and you can see that there is possibility to have impact and financial return. And I asked myself a couple months ago, when this company had achieved such incredible growth, without this sacred impact equation and thinking about risk, return, and impact, would I have even invested in this company? And I'll be honest with you, the answer was no. So what does it actually mean to be in right relationship with capital? This is about both profit and impact, but when we zoom out, it's about purpose-driven investing. It's about long-term thinking. It's about respect for the capital ecosystem and all the players in it. It's about active ownership, not just putting your money in a company and saying, I'll meet the founder, I'll see the tech, I'll write the check, it'll all be good. It's about creating shared value. We call this conscious leadership at my firm. It's about thinking about all stakeholders when you make an investment. Because this is really about asking more, not only about asking more from your money, but really asking more from yourself. So here's a new framework. It's called the Sacred Balance. This is a model that you can apply in all of your decision making. Whether you realize it or not, impact has always been a part of the risk-return equation. And factoring it in consciously ensures that we can create the right kind of impact. And when I say impact, I want you to know that this is not just about classical definitions. This is not just about hitting the targets of the SDGs, which are beautiful, but it's about what impact really means to you as a person, to you as a family, to you as a society, to you as a community. Because viewing it this way encourages more investors to maintain harmony, not only in their portfolios, but in the larger financial ecosystem. So when we think of the sacred balance as impact, risk, and return, we align with purpose-driven leadership. We align with purpose-driven companies, which often and historically in data has been proven to show higher growth than other businesses. So in 2011, I had a really interesting experience with my financial advisor. This isn't me, but it looks like me. And it was pretty much exactly the same conference room in Zurich, looking over a lake, chocolates in the meeting room, all the things that happen in Switzerland, particularly in the banking system. And I was told by my financial advisor that I couldn't take a tobacco company out of my portfolio. He said, "This is a good investment for you. The yield on that bond, it's just good. You have to keep it in your portfolio." And he completely shut me down and ignored me and my husband, who was in the room. Walking out of that room, I felt powerless. It was like my desire to align with my principles, my values, didn't matter. But that frustration for me was a turning point. What I learned was that it wasn't his fault. He just didn't have the tools. And most advisors today still don't understand this sacred equation. They're only looking for financial returns, and it's a race to the bottom. It's a zero-sum game. It's a fear-based zero-sum game. And what that moment led me to do is be here today. It also led me to write my book, The Good Your Money Can Do, and to take my investments to the next level and believe that this is heart-centered work. And what happens when we go down the rabbit hole of not believing that this is true and we ignore the balance is instability, market crash. We've seen multiple of these over the past 2 decades. Crisis, climate crisis, racial inequity. There's so much there that happens when we ignore the balance. But when we line up with the balance, we have stability and growth. Adam Smith warned, I was surprised to read this in The Wealth of Nations, that anything that threatens stability, it's just not worth it. So, respecting this balance for you, I hope brings you happiness. Because the good your money can do isn't just in the profits, but in the lives and the impact that it touches and the impact that it has. When you fully understand the impact of your financial choices, again, that is not just having your money in a bank. That is not just your investment portfolio. That's literally what you're wearing on your body. It's what you're eating. It's what you're buying. It's what you're saying.
Think of sharing what you know.